All right, welcome to a live market update. I'm Vince Gaetano. Thanks for tuning in. We got a lot to talk about. We are headed to a renewal mortgage cliff. It's going to get bad, and we're going to get right into some numbers that are going to just tell the story of where we're headed over the next 24 months. New June sales numbers came out. Boy, real estate agents have a lot of time on their hands because they're sure not selling real estate. And we're going to talk a little bit about what's happening in the insurance market because some insurance carriers are not necessarily offering renewals on projects that are delayed or just behind on their time horizon to get built. So we're going to get into that, and we're going to talk a little bit more about what's going on with the City of Toronto and the new farce that's happening down at City Hall. So, first off, renewals. Thanks to Hanif Bayat of Wow Canada, he came out with some really cool stats. And these numbers are actually alarming. So, monthly renewals will jump to 52% over the next 2 years. Okay, we're talking TD, Scotia, BMO, CIBC, National Bank, Desjardins, BMO. $1.16 trillion in mortgages will be coming up for renewal. That's right, $1.16 trillion. That's $1,160 billion worth of mortgages will be coming up for renewal over the next 2 years. And from May of this year to October, okay, that's about 6 months, we're going to see 7.7% of those mortgages coming up for renewal. That's about 1.28% of all mortgages per month. From November 2024 to April of next year, we got 9.1% of mortgages coming up for renewal. And then next year's May to April 2026, there's going to be 23.4% of the mortgages coming up for renewal. This is obviously the big buying frenzy that took place in 2020, the fall of 2020 to the spring of 2021, where things just went crazy. And here's the problem with these renewals. This is where things are going to get a little bit tricky. So if someone bought a mortgage, bought a home and had a mortgage for about $750,000, and that seems reasonable in the GTA back at that time, okay, they were probably opting for the 1.5% rate, which was a variable. And as we know, most of those products were fixed rate variables, okay? Payments on $750,000 were about $3,000, $29.97 a month. Those folks are going to be seeing rates probably in the high fours, let's call it $4.99, okay? On a 20-year amortization, because 5 years have elapsed, they're going to be looking at payments of $4,760 approximately, okay? That is a 58.8% increase over what they were paying. This is going to be an absolute shit show. For those folks that took a fixed rate, they're not going to see as big an increase to their payment at that $4.99 range, which is where someone could land right now on a 5-year fixed. You know, they're going to be seeing an increase of about 33% increase over their payment that they were paying. So still, it's going to be a big shock to folks at renewal time. And the reality is with everything going up in cost, the cost of living is increasing. We're seeing a lot of people struggle to get through the month. A lot of people are running out of month before they run out of money. They're running out of money before they run out of month. It is really starting to be quite painful. And we're meeting with a lot of clients, talking to them about different situations that they're in. And folks are in dire need of cash flow help. So they're cashing in investments, they're liquidating RSPs, they're trying to do whatever they can to get through the month by having to supplement their income with other forms of cash or income streams and whatnot. It's getting quite concerning. And we're starting to see a lot of folks think about selling. And of course, people are always slow at making that decision, so they're prolonging it, and now we're seeing a lot of listings but not a lot of sales. Because that quarter point decrease in June obviously did not do anything for sales. Treb came out with their June numbers, 6,213 sales in the month of June. That is the lowest level of sales since 2000, 24 years. So there's a lot of realtors out there not doing a whole lot, and they are knocking on doors, they are trying to drum up business, but that quarter point decrease by the Bank of Canada is not spurring any activity. New listings are up about 12% year over year. Sales are down 16% year over year, but in May, they were 7,013, April 7,100, so we're actually going down the last few months. I always like looking at month over month and 3-month periods, and it doesn't look promising at all. It's actually quite a shit show. So I think we're still dealing with situations where people that got in the market in 2020, 2021 that want to get out still have a very high expectation of the value of their property, and people aren't biting. People that are in the market are looking for deals, and the folks that have owned their property for 15, 20 years that have significant appreciation are the ones that are selling because they don't have that high expectation or need to get a certain price to get out of the debt that they put on the property. As I mentioned before, a few months back, there have been a few cases where we had borrowers buy property that they couldn't close, not because of their doing, because the seller couldn't give them clear title. They had too much debt, penalties, and property taxes owing, and they couldn't get clear title to pass on to the buyers. So the buyers just said, give me back my deposit, I'm done, I'm out of here. I want, give me my release, I'll go look for something else. So we are still in a market that hasn't really come to terms with the fact that their property isn't worth what they're listing it for. We're seeing things sit longer. We're still seeing that expectation quite high by sellers. And until people come down to earth on what their property is really worth, I don't think there's going to be a lot of sales. And we're going to need more than a quarter point decrease to drive affordability, because people are still unable to qualify for mortgages at the levels people expect them to spend at. It's just not happening. So there's got to be some give there. But time will tell. With inflation popping up a little bit for the month of May by Stats Canada's most recent report, it doesn't, the May report, I don't think we're going to see a July Bank of Canada decrease. I think we're going to have to wait till September before any further decreases take place. And we're still seeing costs go up. We're still seeing that cost of living elevated at a level that is still a concern to the folks at the Bank of Canada. So, it's going to be bumpy. Put on your helmet, tighten the chin strap. We're in for a long haul. Now, talking to a good friend of mine in the insurance business, owns an insurance brokerage, and we're talking about some projects that we have on the go right now. We're doing some repurposing projects from single family to 4 units, and our renewal's up. We're just negotiating that, and he was telling me that he's got a couple cases where people that have been building some developments have taken longer than expected, significantly longer than expected. In one case, it was approaching 3 years, and because their timeline was 18 months to 22 months, the insurer is not renewing their policy because they feel that the project is not moving at the pace it should. They feel the project has been abandoned. They've gone out and done site visits on this project, and they are no longer offering the builders all risk insurance for this particular project, which leads me to believe that there is some concern from the insurance companies about the viability of these projects and their abandonment, right? Some builders probably are running out of cash. They don't have the resources to build them, don't have confidence that they'll sell at the levels that they're intended to, and it's starting to cause some cracks in the insurance business. And that's something I'm going to keep an eye on. We're going to have some further discussions over the next few weeks with my colleague in the space to try to get a better handle as to what we're going to see. We are seeing insurance costs go up. So in addition to property taxes, we are seeing insurance costs go up, and it just appears that everything is getting elevated, and it's going to have a further negative impact on household income, household disposable income, and it will trickle down to the economy slowing, people not being able to afford things, and it is just going to get worse. So we're in for a long haul. But let's go into the City of Toronto. City of Toronto just recently announced that their original budget for 2 new ferries that transport people from the city to Center Island and Ward Island, the original budget that was set in 2020 was $25 million. And they've just re-upped the contract to $92 million. So, 4 years, inflation is up a little bit, but 25 million to 92 million? How does a contract go from 25 million that was originally approved and budgeted up to 92 million? Something's not right here. Now, they're going off to Romania to build these things, and they've changed it from diesel to some other more environmentally friendly source of power and energy. I think they're going to go with battery powder and a hybrid type thing, and they've had to change the design and all this. Folks, we can't afford this shit. We really can't afford this nonsense. We can't even stick to original budgets, okay? This city needs an overhaul. We need to start drilling down on what we're spending our money on. I can't believe, I was just on Chesswood today. I had to go drive and pick up something, and I went on Chesswood, and they have put in bike lanes on Chesswood from Finch all the way down to Shepherd. Now, I've been on Chesswood many, many times. I play, just pick up hockey every Sunday morning at the rink, and I've been doing that for years. I don't think I've ever seen a bicycle on Chesswood. Never. It's an industrial area. Don't see a lot of families and folks driving down Chesswood where there's auto body shops and industrial plazas and stuff like that. I don't know. Maybe there's a lot of employees that work in the area that ride bikes during the day that I don't see because it's probably just a high peak period in the mornings and maybe at the end of day where people are riding to work. But I doubt it. I really doubt it. Unless there's maybe a flock of people that are coming down to go to the Downsview Park at certain times of the day and weekends. But I've never seen a bike on Chesswood. And what's with all the bollards? There's bollards everywhere, and they're all broken. They're all spewing across the street. Shepherd and Bathurst the other day, I saw a whole bunch that they're supposed to be black, but they're all black because they've been run over with tire marks and knocked over with bumpers. Some are broken in half, and they always get replaced. And I don't think they're cheap. I don't think they're like a few dollars. They're probably a couple $100 each, and they're replacing them almost weekly because people are just knocking them over. They don't see them. So what's the purpose? Why is all this cost going to things that we pretty much don't need? Let's spend our money wisely on where we need it. We got to have a safer city. We got to focus on proper transit. LRT, Eglinton LRT, still not open. Don't have a date. Word is the tracks don't work, not properly sized, platforms not at the proper level. I heard a couple of the subway stations flood. A couple of stations flood in the West End. I don't know. Can we find out? Can we validate that? But really strange that we can't get these things to open up. And the best news is we've just heard that Trudeau's going to run in the next election, which eliminates all those folks that were predicting him to step down. I thought he was going to step down, but hey, he wants to win it. He's in it to win it. Good for him. we could avoid all the noise and nonsense about somebody replacing him and all that. So, you know what, let's just wait. We'll see what happens. But folks, we need to buckle down. Let's focus on our own households. Let's focus on our budgets. I strongly encourage everybody to go through 6 months worth of bank statements, 6 months worth of credit card statements, and identify the needs versus the wants. Get rid of those recurring charges, get rid of those subscriptions, any type of recurring charges that are coming out that you aren't using, get rid of them, cancel them. And better yet, cancel your card and get a new one so that you don't have to go looking how to get rid of some of these recurring charges, because sometimes you can't get a hold of these companies to cancel. So maybe the best thing to do is cancel the card, get a new one, and start over, and maybe have a fresh start on how you spend your money and start focusing on making sure you can get through the next 12, 24 months, which I do believe is going to be quite difficult as more and more companies start laying off, more and more companies are looking for efficiencies and are tapping into that labor force to cut some costs and maybe find some ways to make it through the next 12, 24 months. So, folks, thanks for tuning in. I really appreciate all the feedback and encouragement. If you haven't already, please subscribe to the Wise Old Owl podcast on Spotify and Apple Podcast, as well as the YouTube channel, Owl Mortgage. I'm Vince Gaetano. Thanks for tuning in, and enjoy the weather. Take care.